accounting, chapter 14, partnership. But before we go deeply into partnership, there's a note about the introduction, which is about sole traders. When we talk about sole trader, it's a business owned and controlled by an individual. That's why we call it a sole trader. And we have different features of a sole trader. A single owner provides the capital. Because it's a sole trader, that means the owner of the business will provide mainly the amount of money needed for the business. Owner has rights to all profits earned. Because it's the owner of the business, he or she has put a lot of money into the business, the reward or the return on the investment, it's solely to that owner. Owner pays income tax. Unlike limited companies, they pay corporation tax. So for partnership, for sole traders, they pay income tax, just like individuals. Clear? The owner is responsible. Owner is responsible for all debts of the business. That because it's unlimited, it's a sole trader, it's unlimited liability. So the debt of the business can be transferred to the owner of the business. That's the point there. The next one, owner can take legal actions or can have legal actions taken against them. There's no different entity. There's no entity between them. So that means you cannot separate the owner of the business from the business. So whatever legal actions that can be taken, it can be taken onto the business, or the business can take a legal action too. Do you understand?
What if there's many owners?
No, it's a sole trader.
That's why.
So,
but what if the owner has any other hierarchy? What's called hierarchy?
Managers
underneath him.
It is still a sole trader.
What if he has stakeholders?
Stakeholders are in every business.
So why do they not even face the debts and face all this?
No, because it's a sole trader. A sole trader is a sole owner of a business. Like whoever he or she deals with or relates with, doesn't matter.
Small business.
You could be a big business and still be a sole trader. In as much as you are a sole trader, your debts cannot be transferred to others.
But they have stakeholders.
Every business has a stakeholder. A stakeholder is an
Does he not face?
No, stakeholders are people that have interest in our business. Customers are your stakeholder. Sole trader. Every sole trader sells to a customers. Customers are stakeholder. Government is a stakeholder. The bank they borrow money from is a stakeholder. Their supplier is a stakeholder. So stakeholders are different. But what we're saying is the debts of the business cannot be transferred to others except for the owner of the business.
Okay.
Is it clear? So now that takes us to partnership itself. So when we talk about partnership. So when we talk about partnership, a partnership is just a business that is owned by 2 to 20 people, mostly. 2 to 20 people.
2 to 20?
Yes. Is it clear?
Yeah.
So that's why we call it partnership. Then we go to...
Not 22, 23?
No. It becomes a private limited company.
Private limited.
Yeah. So we go to partnership. We go to the features of partnership. Are you there?
Yeah.
1. No formal agreement is required, only the Partnership Act of 1890. So because it's a partnership, it's more like a sole trader, but the difference is that it has more people involved. And one of the features is that you don't need the article of association or memorandum of association from the registrar. The registrar of companies you don't need any paperwork to start it up. You can just sit down now and we start a partnership. Like the one you said earlier, don't mention, okay? Partnership are entitled to share of profits. So when we talk about partnership, so the profit shared, the profit made by the business, they all have entitlement to it. They share the profit. Each partner is an agent, which means each partner, whatever one partner does, it can affect all the partners. Risk is shared, which means all partners are liable. If one cannot, others will pay. In case there is a debt and one of the partner cannot pay, others have to pay it. Do you understand? So the inefficiency or the negligence of one partner can be transferred to other partners.
Okay.
I think it's clear.
What do you think is much better, is partnership or solo traders?
Well,
there's advantages.
There are the advantages. You have to compare. That's why there's always what we call cost analysis to check the cost benefit analysis, to check the cost of sole trader, the cost of partnership before you make a decision.
But like advantage of sole traders, profit is owned to himself. But disadvantage is that the debt he has to be paid by himself. Yeah. A partnership, it's split up.
Yes.
The debts.
And also remember, for sole trader, the responsibility solely is on your shoulder. Sure. But as a partnership, you can have specialists, and it's, responsibility is shared. Yeah. That's an advantage. So you have to weigh it up before you decide. So that takes us to. No, we continue. There is no legal requirement to disclose financial information to the public. It's part of the features. Do you see it here? Around somewhere here.
Yeah.
Continuation, yes.
It's partnership agreement.
Okay. So another point is that there's no legal requirement to disclose financial information to the public, unlike a private limited company or public limited company, which you have to publish your financial statement. For partnership or sole trader, you don't have to. I think the point is clear. The death of a partner effectively means dissolution. There's what we call partnership dissolution, which means the partnership will end as soon as the death of one partner ends the business.
Okay.
Is it clear? Any question about that? So that takes us to partnership agreements. Are you there?
Yeah.
So for partnership agreement, I wrote, partnership agreement is to regulate the way in which business affairs are conducted. So, when there's no agreement, when there are no terms and conditions, it might be difficult to start a business. So with your partnership agreement, it means we are able to sit down, put things in order, then our affairs are guided based on what we have both agreed upon.
Terms and conditions.
Yes. But in case there's no agreement intact, then we can use what we call the Partnership Act, or the Section 24 Partnership Act of 1890, which are: 1, profit and losses will be shared equally. Because there's no partnership deed, so it means profit and loss will be shared equally. 2, no salaries will be paid to any partner. None of the partners will get salary. Partners should not receive interest on capital invested. No matter what amount of money you put into the business, no interest is received. Partners' loans to the partnership are entitled to 5% interest. So because there's no agreement stated, so if there's a loan, 5% interest has to be given. Clear? No interest is charged to partners on drawing which they make. So, in as much as you're not going to get interest on capital invested, you're not going to pay interest on capital on cash withdrawn from the business. Is it clear? That is drawings, what we call drawings. Is it clear?
Yeah.
So that takes us to accounting for partnership. Are you there?
Yeah.
So for accounting for partnership,